A lot of analysts believe commodities could be one of the biggest stories of 2026, creating a massive opportunity in metals. But while most people think buying a gold coin is their golden ticket, that's actually one of the slowest ways to grow your money. The real wealth is often built with smarter strategies. So today, I'm going to reveal the 3 levels of metals investing, from the safest foundation all the way to the strategies with potentially explosive returns. The why behind the 2026 opportunity. But before we get into the 3 tiers, you need to understand why so many people are watching 2026 as a potentially pivotal year for metals. This isn't just random market chatter. It's a convergence of some powerful global trends. For years, metals like gold and silver were seen as, well, kind of boring, as defensive assets. But that's changing, and fast. We're seeing a perfect storm brewing. First, central banks around the world bought gold at record rates in recent years, well above the historical average. They're diversifying away from the US dollar, and that signals a major shift in the global financial order. This provides a strong, stable floor for the gold price. While forecasts vary, some outlooks, like one from the World Gold Council, see scenarios where gold could rise significantly in 2026. Some high-end forecasts have even floated a path to $5,000 an ounce, though most analysts remain more conservative. But it's not just about gold's classic role. 2 massive technological revolutions are happening at the same time: the green energy transition and the artificial intelligence boom, and both are incredibly hungry for metals. The shift to clean energy requires a staggering amount of copper, silver, and other minerals. A battery-powered electric vehicle, for example, can use up to 83 kilograms of copper. Solar panels and wind turbines are covering the grid, and all that new infrastructure needs to be wired up again with copper. This has led many analysts to warn of a potential structural deficit, where demand could outpace new mine supply for years. Then there's artificial intelligence. The AI revolution isn't just happening in the cloud. It's built with real-world hardware. AI data centers are monsters when it comes to electricity consumption, and some estimates suggest they require nearly 3 times more copper per megawatt than traditional data centers. And silver, with its unmatched conductivity, is critical for AI semiconductors and other high-end electronics. In fact, after several straight years of supply deficits, the demand for silver and new technologies is putting real pressure on the world's above-ground stockpiles. So you have this incredible setup. Gold is being supported by central banks, while industrial metals like silver and copper are being driven by relentless demand from new tech. The era of easy-to-find geology is ending. We're now in an era where securing these metals is a strategic priority for nations. That's the opportunity. Now let's talk about how you can position yourself for it. Introduction to the 3 tiers. When most people think of investing in metals, they picture a pirate's treasure chest or a vault stuffed with gold bars. That's part of the story, but it's just the opening chapter. To really build wealth during a metals upswing, you need to think like a pro, and that means understanding the different levels of exposure you can get. I've broken this down into 3 simple tiers. We'll start with Tier 1, the foundation, which is the safest and most direct way to own metals. Then we'll move to Tier 2, the growth engine, where we add some leverage to amplify potential returns. And finally, we'll explore Tier 3, this speculative play for those who are comfortable with higher risk and are hunting for those truly explosive gains. Each tier has its own risk and reward profile. Understanding all 3 is the key to building a smart and potentially profitable metals portfolio. Let's start at the beginning. Tier 1, the foundation, physical metals, and ETFs. This is your starting point, the bedrock of any solid metals strategy. It's all about owning the actual metal, either in your hands or through a fund that holds it for you. There are 3 main ways to do this: physical bullion, physically backed exchange-traded funds, and the more modern blockchain-based metals. First up, physical bullion. This means owning tangible coins and bars. Think American gold, eagles, Canadian maple leafs, or 100-ounce silver bars. The appeal here is powerful. You can hold it, feel its weight. It exists completely outside the digital financial system, which makes it the ultimate safe haven asset in a crisis. It's not a paper promise. It's a real store of value that's been trusted for thousands of years. The pros are obvious. You have direct ownership, with no one standing between you and your asset. If the banking system hits a wall or your currency stumbles, that gold coin in your safe is totally insulated. It's your personal financial insurance. But there are cons. Physical metal doesn't pay you to own it. It just sits there. In fact, it can cost you money. You need to think about secure storage, like a high-quality safe or a professional vault. You'll also want insurance to protect against theft. And when you go to buy or sell, you will pay a premium over the metal's spot price. That's how dealers make their money. So while it's amazing for preserving wealth, it's not usually the tool for creating it quickly. Now for the second part of Tier 1, physically backed exchange-traded funds. These are funds that trade on the stock market like any other stock, but their whole purpose is to own and store giant piles of a single metal. The most famous examples are the SPD, our Gold Trust, GLD, and the iShares Silver Trust, SLV. When you buy a share of GLD, you're buying a tiny piece of a massive vault full of gold bars. The ETF's price tracks the spot price of gold almost perfectly. The pros here are huge, especially for beginners. It's incredibly easy. You can buy or sell shares instantly through any brokerage account with low fees. You don't have to worry about finding a reputable dealer, paying high premiums, or figuring out where to store a bunch of heavy metal. It's the most convenient way to get exposure to the price of gold or silver. What's the catch? You don't actually own the metal? You own shares in a fund that owns the metal? Well, funds like GLD are heavily regulated and audited. There is still a layer of counterparty risk that doesn't exist with a coin in your hand. You're trusting the fund's managers and custodians. For most people, this is a tiny risk and a fair trade-off for the convenience. Finally, a third and newer option is emerging: blockchain gold and silver. This involves buying digital tokens that represent direct ownership of physical gold or silver held in a secure vault. Each token is a digital certificate, backed one-to-one by real, allocated metal. The pros here combine the best of both worlds. Like physical bullion, you have a direct claim on a specific amount of metal, which some tokens even allow you to redeem, but it trades with the ease of the digital world. You get 24/7 trading, the ability to buy tiny fractions of a bar, and often lower fees than ETFs. The cons are that it's a newer technology. You need to be comfortable with digital wallets and understand that you are trusting the issuer of the token and the security of the blockchain it runs on. It's an innovative space, but requires careful due diligence. So, Tier 1 is your foundation. It's your safe haven, your protection against inflation and uncertainty. It gives you pure, direct exposure to a rising metals price. But it's generally not where the life-changing returns are made. For that, we need to climb to the next level. Tier 2, the growth engine, major mining stocks. If Tier 1 is about owning the metal, Tier 2 is about owning the business of pulling that metal out of the ground. This is where we introduce the concept of leverage, and it's where you can start to see returns that dramatically outperform the metal itself. We're talking about investing in big, established mining companies. These are the giants of the industry companies, like Newmont Mining or Barrick Gold. They're large, publicly traded corporations with mines all over the world, producing millions of ounces of gold or silver each year. You can invest by buying their stocks individually, or, for a simpler approach, by buying a mining ETF like GDX, which holds a basket of these major producers. So, why do this instead of just buying the metal? One word: leverage. A mining company's profit is tied to the metal's price, but in an amplified way. Let me give you a simple example. The other big pro is that, unlike a bar of metal, mining companies are actual businesses that generate cash flow. Many of them even pay dividends, so you can get paid to wait for the stock to go up. Driven by strong demand, the broader mining market is projected to see healthy growth. Now, for the cons, and they're important. When you buy a mining stock, you're not just betting on the metal's price anymore. You're also taking on all the risks of running a business. A mine could have a flood or a collapse. A country where they operate could suddenly hike taxes. Management could make a disastrous decision. And of course, it's still a stock. If the S&P 500 has a bad day, even a profitable miner is likely to get dragged down with it. Investing in Tier 2 takes more homework. You're not just watching the gold price. You're analyzing balance sheets, management teams, and geopolitical risk. But for those willing to do the work, this is the growth engine of a metals portfolio. And hey, if you're finding this breakdown helpful, do me a favor and hit that subscribe button. We go deep on strategies like this every single week. Tier 3, the speculative play junior miners and royalty companies. Alright, welcome to Tier 3. If Tier 1 is your foundation, and Tier 2 is your growth engine, Tier 3 is your speculative rocket fuel. This is the highest risk, highest reward corner of the metals world, and it is definitely not for everyone. But it's also where those rare, life-changing 10x, 20x, or even 100x returns are born. This tier includes two main types of investments: junior mining stocks and royalty companies. First, the juniors. These are the wildcatters of the mining world. They are tiny, exploration-focused companies, often with a market cap under $500 million. They usually don't have any producing mines or revenue. Their entire game is to raise money from investors and use it to drill holes in the ground, hoping to find the next giant mineral deposit. The risk here is huge. The vast majority of junior miners fail. They drill, find nothing, run out of money, and the stock goes to zero. You are literally betting on a geological treasure hunt. So why on earth would anyone invest in them? Because of those rare, incredible jackpots. When a junior miner hits that one magical drill hole and proves they're sitting on a world-class deposit, the stock can go up more in a few days than a major miner will in years. It's not uncommon for a successful junior to get bought out by a major for a massive premium, delivering astronomical returns to early investors. But let's be clear, this is high-stakes speculation. Never bet money you can't afford to lose on a junior miner. for a small, speculative slice of your portfolio. However, it offers upside you just can't find anywhere else. Now, there's a slightly more conservative way to play this high-leverage game: royalty and streaming companies. These companies have one of the most brilliant business models in finance. Think of firms like Franco-Nevada or Wheaton Precious Metals, which act as specialty financiers for the mining industry. Here's how it works. Building a mine is crazy expensive, and miners often need cash. So, they go to a royalty company. The royalty company gives the miner a big upfront payment, say $500 million, to help build the mine. In return, the royalty company gets a percentage of all future revenue or production from that mine for the rest of its life, often without paying for any of the ongoing costs. A royalty is a cut of the revenue. A stream is a bit different, giving the company the right to buy a percentage of the mine's metal at a deeply discounted fixed price, like buying gold at $600 an ounce, no matter what the market price is. See how powerful that is? These companies get all the upside of a rising metal price and new discoveries, but they are largely insulated from risks like rising labor or fuel costs. They're also highly diversified, with deals on dozens or even hundreds of mines. So one problem at one mine doesn't sink the ship. Well, they are not risk-free there. Still exposed to commodity price drops and project delays, they represent a much smarter way to get exposure to that high-octane exploration upside. To play it safe in the junior mining space, invest in an ETF that includes many junior mining companies. This will diversify your risk, but still gaining the upside from the junior miners. The most famous examples are the VanEck Junior Gold Miners ETF and Amplify Junior Silver Miners ETF. So, let's quickly recap the 3 tiers for playing a potential metals boom. Tier 1 is the foundation. This is your direct exposure through physical coins and bars. Convenient ETFs, like GLD and SLV, or modern blockchain tokens. It's all about safety, security, and wealth preservation. Tier 2 is the growth engine. Here you invest in established, major mining companies. Maybe through an ETF like GDX you get the benefit of operational leverage, where a rising metal price can supercharge profits, plus the chance for dividends. And Tier 3 is the speculative play. This is the higher risk, higher reward world of junior exploration stocks, where you're hunting for a discovery. Or, for a more strategic approach, you can invest in royalty companies, which act as the smart money financiers of the industry. The key takeaway is this: profiting from a metal cycle is about more than just buying a single gold coin and hoping. Real wealth is often built by understanding these different tiers and layering your exposure. You can build a solid foundation in Tier 1, aim for amplified growth in Tier 2, and take calculated shots in Tier 3. This is how you move from a beginner's mindset to a sophisticated strategy, positioning yourself not just to survive economic shifts, but to potentially thrive in them. Now, I want to hear from you. Which of these 3 tiers are you most interested in? Are you focused on building a physical foundation, capturing growth with the majors, or are you drawn to that speculative potential? Let me know in the comments below. And if you want to keep getting actionable insights, make sure you're subscribed. Thanks for watching.